Hello everyone, today I'm going to talk about the bond valuation. Bond pricing and maturity. Why bond B prevails? Bond B will typically trade at a higher price in the market compared to bond A. This is because bond B has a shorter time to maturity. Shorter term bonds are generally less risky because they return the principal sooner. Investors typically prefer lower risk, so they are willing to pay a premium for bond B over bond A. The impact of rising interest rates on bond prices. When interest rates in the economy go up, the market prices of both bonds A and B will decrease. Here's why. In the bond A, which is 30 years of maturity, its longer maturity means it is more sensitive to interest rate changes. If rates rise, newer bonds with higher yields become available, making bond A less attractive. Therefore, its price will fall. But then, in the bond B, which is 5-year maturity, while still affected by interest rate changes, bond B is less sensitive due to its shorter maturity. It will also experience a decrease in price, but the impact will be less severe than that on bond A. Duration and price sensitivity. Why bond reacts more? Bond A would have a higher percentage price change if interests go up. This is due to the concept of duration. Duration measures a bond sensitivity to interest rate changes. This is why bond A has a longer duration because it has a longer time to maturity. Longer duration implies greater price sensitivity to interest rate movements. So if interest rates increase by a certain percentage, the percentage decrease in bond A's price will be larger compared to the bond B. Bond price movement in action. Let's illustrate with this a simple example. If interest rates increase by 1%, bond A's price may drop by approximately 23%, while bond B's price may drop by around 4%. This demonstrates the higher sensitivity of bond A to interest rate changes. Bond investment strategies in the economic slowdown. Shift to safer bonds. Move towards safer bonds such as government bonds or highly rated corporate bonds, which are less susceptible to default during economic downturns. Second is a shorter maturity. Reduce exposure to long-term bonds like bond A and focus on shorter-term bonds like bond B. Shorter maturities reduce interest rate risk. Diversification. Diversify your bond portfolio across different issuers and sectors to spread risk. And the fourth one is monitor the yield curve. Keep an eye on the yield curve for signs of economic trends. An inverted yield C curve, a short-term rates higher than long-term rates, may indicate an impending recession. In conclusion, bond B typically commands a higher market price due to its shorter time to maturity, which appeals to risk-averse investors seeking quicker principal return. When interest rates rise, both bond A and bond B experience price declines, but bond A, with its longer maturity and higher duration, undergoes a more significant percentage price changes, illustrating its heightened sensitivity to rate fluctuations. Numerical examples sustainable these principles. As an investor anticipating an economic slowdown, it is prudent to pivot towards safer bonds, shorten maturities, diversify portfolios, consider inflation-protected securities, monitor the yield curve, and stay informed about economic indicators to make well-informed investment decisions that align with evolving economic conditions. These are the references that I used, and thank you for listening.